Hey there, welcome back to Accelerated Real Estate Investor with Josh Cantwell. I'm your host, and today I have a great conversation with you and for you with Spencer Gray. Spencer is the president of Gray Capital. He is the president. He leads and develops their investment strategy, performs due diligence and underwriting for all of their multifamily portfolio. They've been involved, and Spencer in particular has been involved in $1 billion of transactions. And check this out. He started with his first rental property in 2006 as a residential investor. So for those of you that are looking to grow and go from resi to commercial, resi to multifamily, this is a fantastic interview and conversation, especially for you. Spencer actually started investing immediately out of high school. So also, if you're somebody that does not have an advanced degree, did not go to college, or somebody that even went to college and is not using their degree at all, this is a fantastic conversation about why going the entrepreneurial route immediately out of high school and foregoing an expensive college education. This is a true example of someone who has an amazing success without that advanced degree. Spencer is a true entrepreneur. He's founded several successful businesses in media distribution, real estate, and agriculture. He has extensive experience in real estate investing strategies and raising money. He's been doing that since 2006. He's also an avid rock climber, fly fisherman. He loves to free dive. If you're not familiar with that, free diving is diving deep into the ocean with no tanks and no diving gear. Pretty amazing stuff. Young guy. They also have Gray Capital as an amazing newsletter that you're going to want to check out. And in this conversation, I think a couple of the major points that we discuss is number one, why the 2019 multifamily market is completely 180 degree different than the 2022 market that we're going to be experiencing next year. Number two, we're also going to talk about why the residential and multifamily markets are going to continue to grow because the top line revenue growth, the top line rent growth continues to grow. Number three, we're also going to talk about where and how to find Midwestern markets that have not only just cash flow, but also 15 and 20% appreciation, similar to the Sun Belt, but that have cash flow opportunities because they're in the Midwest. And also we're going to talk about elevated inflation and the ultimate role of the Federal Reserve and why they are not on your side. So this is an amazing interview with Spencer Gray. You're absolutely going to love it. Check it out. Here we go.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you're looking to retire early with forever passive income, you're in the right place. This podcast is the go-to destination for real estate investors, both active and passive, and multifamily apartment investors, both new, intermediate, and advanced. Now, sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So, hey, Spencer, listen, so excited to have you on Accelerated Real Estate Investor. Thanks for carving out some time.
Hey, absolutely, Josh. I've been looking forward to this. Yeah, I'm happy to be here.
Fantastic, guys. Listen, as you listen to this interview and this discussion, I think we're going to really love this for a couple of reasons. Spencer and I were prepping for this, and we have a very similar path. Both started in resi, both started co-GPing and co-syndicating deals with joint venture partners, scaled very fast, then got to the point where we were doing a lot of our own deals with our own team, co-sponsoring our own loans, raising our own capital. So Spencer, we're just going to have a very frank discussion about some of the things that have worked for him and me, because I think, frankly, Spencer's path and my path is a path that every single one of you in this audience is listening can follow, starting with resi and scaling up from there. So Spencer, welcome to the show. I'd love to hear some of the things that you're up to today. literally like right now. What are you
Yep.
working on? What are you working on today? What are you working on next week that gets you going, that you're passionate for?
Yeah, well, I mean, obviously, always looking for good deals, making offers. Doing a lot of losing really good deals right now. But something we've been focused on past couple months, but really we're really kind of nailing it down right now. Is we're going to be launching a fund kind of Q1 of 2022. So we're kind of figuring out the details of that process right now. We're sticking to kind of the strategies that we've been successful at the past 6 years. Keep executing on good projects, trying to find inefficiencies in the multifamily space, targeting stabilized multifamily assets primarily in the Midwest. But moving to the fund model is going to make us much more competitive, much more agile, and to really continue to scale, our portfolio, and really just make us much more lethal in terms of being able to execute on deals.
Nice. I love it. Tell me about the structure of the deals. Is it open-ended, close-ended? What types of deals is it going to target?
Yep. It's a good question. And to be honest, we're still working out some of the details, having conversations with some of our lead investors to kind of see what their preferences are. Because, we've been, big proponents of doing single asset syndications for a long time, building out your own diversified, just bespoke portfolio. And so really kind of leaning on kind of some preferences of our kind of existing investors. Most likely it'll be a close-end fund, just because, most investors, want some kind of exit period. They don't want it to be necessarily indefinite. Although, some investors, do like the concept of really something that's more perpetual, continuing to go on for an extended period of time, but lean towards the close-end route. It'll be a $100 million fund. We're going to go relatively large for our first fund. So again, targeting stabilized assets, kind of the light value add to core plus, which has been our sweet spot. And we're excited to get going.
Nice. Fantastic stuff. And you focus on the Midwest, you mentioned.
Correct.
Why the Midwest? What are some of the things that you like particularly about the Midwest? Obviously, so many people are really focused on the Sun Belt.
Yep.
And the South. I'm from Cleveland and I love the Midwest. We've got assets in the Sun Belt. We've got stuff in Atlanta. We've got stuff in Oklahoma. We've got a lot of stuff in the Ohio market where we're from.
Yeah.
I love the Midwest. I don't want people coming, but what was your thoughts on focusing on the Midwest? What did you like about it?
Well, first it was just the natural, market because, I'm from the Midwest. I'm, born and raised in Indianapolis. And so investing in a market that I already understood, made a lot of sense before I even started, digging into really other markets and really breaking down different regions, understanding kind of migration patterns. And so, we'd started investing in, really what we knew. But now, knowing more and learning more about other markets and, how popular the Sun Belt is, not only to, new residents, people migrating from, northern states, but also from investors and capital, and seeing significant capital flows to those Sun Belt states. And what we started seeing as we started really trying to kind of get into those, some of those Sun Belt metros, is that, it's incredibly competitive. And sometimes the returns ended up being much less attractive compared to some of the projects we were finding in the Midwest, and specifically in Indianapolis. And so what we started noticing is there's just this inefficiency in the market of where so many properties in those Sunbelt metros are getting bid up, and for good reason, because they've got great stories, great growth metrics, and people are making a lot of money. What we found is the Midwest offers just a different return profile. Being more balanced, being slightly more weighted to cash flow and income, as well as getting appreciation, compared to a lot of Sunbelt metros where there's so much growth and you're paying up for that growth. And the growth is certainly there, but the translation to that is you usually having, a ramp up to cash flow starting at a lower cash on cash. And then typically you're going to still get a great equity multiple because you're going to sell it, at a low cap rate because that growth is continuing, but just a more balanced return profile in a lot of these Midwestern metros. They're still growing at similar growth rates, especially in some of the suburbs, as a lot of Sunbelt metros. I mean, there's suburbs in Indianapolis that our rent growth is 20% year over year, and 2% annual population growth. But
yeah, I love it. I love it. I love the fact that you're breaking down opportunities, and sometimes it's so niche, right? It's such a small submarket that has some of those same growth patterns as the Sun Belt. Many people are like, well, we're just going to the Sun Belt because that's where everyone's going. True. Yes. But there are other states, there are other markets that make sense besides Houston and Arizona and Tampa, Florida,
Yes.
and Charlotte and those kind of areas, which is great. Spencer, I'm curious, what is your take on the market right now? You've obviously dug into it a little bit with some of the growth in the Sun Belt, but just generally, there's so many different levers being pulled right now, politically, economically, inflationary. Just what are your thoughts and comments? What are you prepping for in the next couple of years?
Yeah. I think that there's a perception of a great amount of uncertainty. And I mean, there still are some things that we don't know, and no one will know until things play out over the next couple of years. But the whole question of, are we going to see inflation? That's no longer even, it's not a debate. It's, we're seeing significant elevated levels of inflation. And the question is, right, so how much and for how long? How persistent is it going to be? And, looking at not just, commercial real estate, but just markets in general, we're seeing, all-time highs. And what's fascinating is it's not necessarily just being driven only by speculation, but it's being driven by, revenue growth in earnings, whether you're looking at, public securities, but in, commercial real estate and in multifamily, I'm sure there's a lot of cap rate compression, but the growth that we're seeing is being driven by kind of that top line income growth and rent growth. And so if we're seeing incomes also grow, which they need to still continue to pick up, it starts to make a little bit of sense, because when you have market rent growth growing by 15 to 20%, even 30% in some markets, there's going to be a 2 to 3 year period of where in-place rents get traded out, and you're simply doing a mark to market strategy of just really bringing leases up to current markets, which you're already getting at. And so it creates a really different investment dynamic than we've really been living in over the past, really decade or so, where you were really looking at value add strategies, needing to really force that appreciation to get that, $200 of, rent premium. That $200 rent premium is already built in just based on where the market has moved. And so you've seen that's led to the significant compression in cap rates, because sophisticated buyers have seen where revenues are going to go. And all of a sudden, current cap rates don't matter as much because they're willing to pay up more for future growth.
No doubt.
And where that line is, that's what's hard to figure out, is how much growth are we actually going to see and for how long, and who's willing to speculate and accept lower returns today for participating and getting a good deal maybe in the future.
Yeah. And to the point where I've never seen so many operators using bridge loans, so they have to bring less capital to close. And so many guys really even bleeding cash in the first 6 months, 18 months, going negative in order to acquire the building, in, again, pro formaing out, projecting, in some cases, obviously speculating on those rent growths that are 3 and 4 years out. And where's the top of the market? Like, nobody knows. And every operator, every buyer, every sponsor is going to have their different metric. I'm looking at a deal now that, I just underwrote it again this morning and reviewed it with my team. And we see, current in-place rents. This is in a really good part of Cleveland, but it's been owned by the same family for 60 years. Yeah. The rents are at least $200 or $300 below market value today. And it's in one of the top markets in the area, where we could see rent bumps beyond that. It's hard to wrap my head around a possible $400 or $500 rent bump, but because they're already 20 or 25% what we see below market value today, what other people are charging today. And if we do a significant CapEx plan, we're going to be then in the top, 75% or 85th percentile when it comes to our rents compared to the rest of the market. So then you're going to see another $200 or $250 on the other side of the average, on the other side of the mean. And I'm trying to tell my team, like, are we really going to see a $400 rent bump in this market? And it's like, the numbers don't lie, man. They're there. We've never really seen that before, though.
That's what's been difficult, is catching up to today and looking to the future, because things have moved so quickly. The ground's moving so fast underneath our feet. And if you're not really paying attention, you look at a headline number and saying, we're going to move rents $400, or, we're going to be whatever, 20, 30%. If you're looking at the mindset of 2019, 2020, like that's absolutely ridiculous. That's most of the aggressive numbers I've ever seen. And a lot of, I know people are underwriting, organic rent growth after the big lift of in the 4 to 5% range, as opposed to your typical 3% organic rent growth. You would have never seen that type of activity happen a couple of years ago. And it's because, the growth is there, but this is also the environment that, easily can lead to asset bubbles, is when you see, what asset classes do you want to be allocating to in an inflationary environment? When people have excess cash out there, savings are at all-time highs, markets in general at all-time highs, where do you go? Commodities, might make sense, but they're not going to pay you any cash flow in the meantime. But when you think of multifamily apartments, not only is it proven, hedge against, inflation, it's because we can track inflation on a daily basis. Because if you have a portfolio, you're signing new leases at new market rates on a daily basis. Right. There's very few investments out there in asset classes that, even in commercial real estate, that provide that kind of inflation hedging ability. And so we're going to see even more inflows into the space from other markets, new real estate investors, as well as investors who've been investing in retail and office, who are very uncertain about those asset classes. And I think also we're going to probably see inflows from Asia and outside of the United States into U.S. real estate, because there have been some outflows in recent years. And people are going to be searching for a safe haven, seeing the United States as a generally more stable economy compared to the rest of the world. And specifically multifamily assets as being this really unique asset class. So I think it's not going to be, it'll be an interesting couple of years. And when I see people paying these insane prices that I can't justify today based on just our metrics, I still say, and we just lost out on heard about, this morning, lost out on a big deal. And I'm like, well, we can't go there because, it's crossed our line in the sand. We've got to be disciplined. But at the same time, they've got a good deal. It's going to be worth $10 to $15 million more in 5 years from now. I know it is. And so we can't come up $1 million or $2 million, but I still think in the long run, it's going to work out for them. It's just, we've got our line in the sand and our criteria. So.
Yeah, no, that was so well said though, Spencer. Thank you for that, because high level summary, when you have office, retail gotten pummeled, nobody knows if there's coming back, those dollars are going to go where? Multifamily, right? Yeah. Multifamily is the darling asset of COVID. It performed well, even with the eviction moratoriums, rental, slush funds being set aside. It performed really well. There's going to be some, not a lot, but some upheaval in the resi space because those prices are going to top out. Yeah. And because there's going to be some additional foreclosure activity next year. When there is foreclosure activity, those people are going to move into apartments. And look, if there is any kind of chaos that hits the market, people living in A-class buildings are going to move to B-class. So B-class workforce is going to continue to do well. So for all those reasons, sure, you could see things continue to appreciate. But again, I love the fact that you said we have a line in the sand. We're still not going to cross it. We got to be disciplined. Same here. It's a deal we just lost out on that we went all the way up from, we started at about 16, 17 million. If I remember, we ended up in the 20 million range with our final invest, and it traded at 21 and a half. And I'm still like, they still got a good deal. Like, good for them. It's crazy, but I could see that value continuing to go up. So fantastic stuff. So Spencer, what is exactly your strategy? Help us understand your structure for a deal. Is pref return? What type of you like to buy? You mentioned staying disciplined. So disciplined to what exactly? What is your model?
Yeah. So, I'll talk about, our model that we've done in the past. And, when we move to the fund, it's going to be slightly different, but kind of very similar philosophy in ideas. So we try to keep things, pretty simple in terms of our deal structure. So, we only offer, one class of membership units into our projects. We offer a preferred return. It's been 8% on our past 3 deals. It'll probably continue to be 8%. And then we offer us, 70-30, LP to GP split, after that. So very vanilla, very straightforward, very familiar, to a lot of many investors. In terms of, kind of our strategy and our risk profile, we're right in that light value add to core plus space. But really looking for assets that we believe are undervalued, or there's just some inefficiency in the market where we can find kind of a wedge opportunity to find some really great value, some good bases, and where assets that for one reason or the other, maybe some buyers have just looked over or discounted, or we're looking in markets that are just overlooked at times. And so a couple examples. We during COVID last year, we acquired a newer asset built in 2018, but it recently come out of a lease up, and it was a little bit more difficult to put financing in place. They were bloated with concessions and marketing and admin budgets that were unnecessary. But it was in Granger, Indiana, which is a submarket of South Bend. And not as many investors were, one, it was in the middle of COVID, so no one was flying out to South Bend, Indiana at that time. So no one was even touring the asset. They just weren't playing
football. So,
yeah, exactly. Well, that was the thing. It's, people were like, well, I've never heard of Granger, Indiana, but it's like, well, if you've heard of South Bend, it's literally it's a 10-minute drive to, Notre Dame's campus. There's actually a decent amount going on in the market, but just people were discounting it and we're not looking at it. And it provided an opportunity for us to get in, buying it under whisper price, which is never happens, now, a year later. We paid $62 million for the asset. And today, if we look at our trailing 3-month NOI, and if we put kind of the market cap rate, even just being conservative, putting not up the 4.5 of which we would probably trade for today, but even a 5% cap rate, the value is closer to $75 million over essentially a less than a year period. Just because we bought when no one else was looking, they were mispricing the asset itself. We saw a pretty clear trajectory to really not take a lot of renovation risk. It was all operations. It was burning off concessions, running the property more efficiently. And I mean, we're going to be cash flowing over double digits this year at a Class A luxury asset that when you would look at it on its face value, you would just make an assumption that that's going to be a low return asset because of the quality. But just finding those unique moments in time and just things that are discounted just because people aren't willing sometimes just to take the time to dig into it. I mean, just literally people just didn't want to fly out and tour the property. They weren't willing to take a 3-hour drive from Indianapolis or Chicago. And we were able to pick up a great asset. So just finding situations like that. And, we wish that there were more of them. It's led to us doing, less volume because we're trying to find great deals, not just, and we have this conversation all the time. It's, we don't want to do deals just to do deals. We'd rather just do only, incredible deals and build a track record of having, just incredible results and, finding great opportunities. And if we miss out on a deal that's on the margins, sure, we could have overpaid for it. But then all of a sudden we're just doing deals to do deals. And so that's what gets us excited, is to find those inefficiencies in the market, those just unique opportunities where we feel like we're not taking as much risk as other strategies. Like we're not doing very large renovations, although we've done those in the past, and we've done full gut rehabs. But when we can find a deal where we can go in, create good cash flow from day one, really just tweak the knobs, improve things, do targeted, CapEx. We feel like it's a really great risk return profile.
Yeah, I love it. That's fantastic. Thank you so much for that explanation. And yeah, I mean, there's different places to take risk, right? There's operation risk, there's CapEx risk, trying to get a deal to stabilization, refi risk. You got to pick and choose your battles, right? Yep. You got to get those risks limited. Today, we're really focused on acquiring buildings, as many as we can, that are stabilized, 90, 95 or more occupancy, but need that kind of light to medium value add where we can still get permanent financing, non-recourse off the rip. And we can raise a little bit more capital with private investors so that if there is any kind of chaos in the market, I believe there's tremendous amount of upside. I'm very bullish like you are, but sometimes you just don't know what you don't know.
Yep. Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast.
We're talking more and more conversations with our staff about, look, Lehman Brothers took the whole market down. And, you start to hear about some of these huge banks in China that in the 62 million vacant units they have.
Yeah.
Is it feasible? Is it possible that some of the banks and the developers in China could have some significant disruption in the entire global economy? I don't know the answer to that. I'm not a global.
Wait, Josh, you're saying that we completely reset the entire world economic system, and there may be some hiccups in the next couple of years?
Yeah.
You would think so, right?
Something that happened 10 years ago, right?
Yeah.
It happened.
And why can't it happen again? And there's always something that's present that we're not aware of. There's always those black swans that are out there, and so much has changed so quickly with so many people, institutions, either not catching up, and we live in a different world in 2021, 2022. It's completely different than it was 2 years ago. And I think most of us are still operating off of probably the old playbook. And I think very few really understand what, the new playbook is. I don't think that the Federal Reserve, understands it. I mean, it sounds like, they appear to be pretty behind the ball in terms of catching up with inflation and trying to cover for saying, how long can transient inflation be transient? If it's prolonged, it's kind of the opposite definition of transient. And so, the leading economists that are supposed to be, controlling the economy, they don't really know. They don't have the crystal ball. So, it's left to us as individuals to kind of figure it out and, find those opportunities. But
or let me add this. I wasn't going to go down this bunny trail, but let's go, Spencer.
Yeah, let's do it.
Right, the global Federal Reserve, the global central banks, and the governments are in a race to print money. They're all printing money. It's not just the U.S. Federal Reserve. It's China. It's all the central banks. The European Union, all the central banks are all printing money at unprecedented rates. We have liabilities that none of these countries can afford. It's not just the United States. It's every single economy. They're all printing money. They all have liabilities that they can't afford. The only way out of it is inflation.
Yep.
So is it possible, which that's a loaded question, right? Is it possible that they want inflation, the Federal Reserve wants and is encouraging inflation on purpose, because the lower the value of the dollar, the more that these liabilities, the less these liabilities are, because the dollar's worth less. My opinion is that the Federal Reserve is doing it on purpose. These supply chain issues are real and they're on purpose. I think Joe Biden is a puppet who is playing into it on purpose. I think the Federal Reserve knows exactly what they're doing, keeping interest low. And I also feel like the Federal Reserve is a private bank. Like we all know it's owned by separate people. It's not part of the federal government. And what it's allowing is by keeping interest rates low, it's allowing people that are already at the top of the pyramid, the top 1%, 5%, 10%, to borrow more money at cheaper rates to consolidate the wealth at the top. Now, the good thing for you and I, Spencer, is that we're in that group. We can borrow money at really cheap rates. We can buy assets at really cheap rates, and we can participate in that. The trouble is, and I think, is that the global middle class and lower class can't participate, and things are going to get more widened, more disparaging between the upper class and the lower class. That is not good. And ultimately, I have a feeling that the Federal Reserve is actively allowing this to happen to dilute all the liabilities that are on the books, and inflation's the only strategy they have. But a lot of people are going to get left behind, man. And I'm just afraid to see what that looks like.
Yeah, no, I tend to agree with you 100%. And I don't think that's even, a question of whether that it's the plan of the Federal Reserve to devalue the dollar and destroy the debt via inflation. I think that is the stated plan. They've been saying for years, we need higher rates of inflation. Let's, instead of using a 2% target, now we're going for an average of 2%. So we can run at, 4 or 5%, for years, because then we're going to take a long period to get a 2% average. And that's what I tell my friends all the time. Because you're absolutely correct. It's, using the tools that like the top 1% are using to accumulate significant amount of debt backed by real assets that are producing cash flow. We're using, that strategy in the playbook that, family offices and ultra high net worth individuals have been using for centuries, and beyond. And also looking at the playbook of the Federal Reserve, understanding what they're doing, and really trying to take advantage of it and exploit it. And I tell my friends all the time, even if they aren't investing, it's no longer a question. I feel obligated to say, look, if you're not investing in some kind of asset, obviously I love real estate, but even in the stock market, in equities, some type of asset that's going to at least track inflation and be able to grow over time. Because if you're relying on your income and your wage, it is on a linear growth trajectory, and these asset prices are going to be on an exponential growth trajectory. And because the difference between the folks who are going to be left out is going to be tragic, and unfortunately, we've seen time and time again throughout history, that leads to such great conflict. And so, if we could, build a more, better, civil society, from the bottom up rather than the top down, to educate people and say you really have to start allocating yourself, and you have to start thinking about the future and what's happening. And I feel obligated to tell people that I know. And again, they may not be able to invest in our projects because we only allow accredited investors, but say look, you have to start getting yourself allocated to some type of assets.
No doubt. I mean, look, the dollar's down almost 5% with inflation, but crypto, cannabis, stocks, bonds, real estate, it's all up. Yep. Money doesn't have to sit in cash, right? So it's got to get invested in order to keep up and outpace inflation. And I think that's great advice. And Spencer, let's just fast forward to that.
Yep.
Like, you've had a lot of success now, 9,000 units, lots of syndications. You've raised lots of money, standing up a fund. Looking back, what would you do differently, if anything? What advice would you give to our audience or to your younger self? You look pretty darn young, by the way. You started young. You are young.
Yep.
That's one piece of advice I would give our audience is start young. They don't have to wait.
Yep.
I mean, started investing when he was just out of high school.
Yep.
And we'll circle back on some of that introduction later, but what kind of advice would you give to yourself or our audience, whether it's navigating today's market or just some, early challenges that you face along the way? What would you do differently?
I think that the biggest thing is, don't fall into your natural limiting beliefs of, what can I do now? What do I understand at this moment, as opposed to what can I do in the future and what's possible? And when I talk to, newer real estate investors, and, they talk about, I've got this much money for a down payment, what should I do? I think it's important, let's take a step back and let's look at what is the real long-term goals here. What are the best investment strategies? And don't exist in the box of, these are the resources that I have today, and more building the plan and then figure out what the pieces of the puzzle is, and start putting that puzzle together and start painting that picture, because there are opportunities out there that are going to be incredible, but that are going to be outside of your ability. And if you don't have the foresight to say, all right, this is just a problem that we need to find a solution for, and it's 100% possible. We just have to, whether it's building the right team, putting the right people together, you start doing bigger deals, you start growing faster, and it includes being pretty uncomfortable sometimes because you're doing something you haven't done before, but I would go bigger, faster, and just don't focus on what you can do today.
Yeah, that's such good advice. That self-limiting belief is so big. And I think the one thing to keep in mind is, look, almost every major deal, whether it could be a small restaurant, $500,000 restaurant, or $1 million restaurant, apartment building, an e-commerce business, or a large social media platform, none of those deals were done with just the operator's cash. They were all done through some sort of joint venture, some sort of syndication, some sort of investor pool, some sort of group of people that came together. It could be 4 people, it could be 400 people, it could be whatever. In none of those circumstances did one person with just themselves and just their money get wealthy. It was always done through some sort of group, pool of investors, syndication, some sort of joint venture, it was some sort of network that made it happen. And so the pie got so much bigger that everybody was willing to take a smaller slice of a much larger pie.
Yeah.
Versus, hey, I've just got my little slice of pie. How much of this can I eat, or how much of this can I invest? That's a different, mindset. I think that's fantastic advice, Spencer. Thank you for that.
No, absolutely. Yeah, I think people don't believe that other people will believe in them necessarily. And who's going to give me money for a project and believe in me? But if you believe in yourself, there's the money's out there. It's just but you have to take the step and you have to ask for it. If you don't try to ask for it, you never know what you can actually do. So might as well just get out there and try.
Spencer, let's finish up with the final five. Yep. You ready for these?
Let's do it.
We'll hit these super fast. All right, let's start with this. What's your absolute favorite way to find new deals?
Favorite way to find new deals is we get a call from, I love it from the owner directly, but even if it's from a broker saying, we've got the perfect deal for you guys, the seller needs to move incredibly quick. You guys are the buyer for it because we know that you've executed in the past. Send over send over an LOI. We'll get the PSA wrapped up in a week or two and ready to go. Nice. That's my favorite way to find new deals is because it's known broker relationship, ready to go. No bidding process, and just a nice little matchmaking process.
Nice, I love it. How about your capital stack? You said accredited investors only. You're going towards a fund structure, but you've done basically one-off type of syndications, one deal at a time. What's been your favorite way to fill up that stack?
Favorite way to fill up the stack is really through a combination of a handful of large anchor investors, a few large family offices. We're typically investing kind of $1 to $2.5 million. And then we've got a lot of investors who are investing, 50 to 250. And because, I love working with the bigger groups, you can write the big checks. Obviously it moves the needle, but we built this business and company to work with multiple investors and help individuals, build portfolios and grow their wealth. So, working with people who are passionate about investing in real estate, we're never going to not do that, even though we have investors who can write, $10 million check to get a whole deal done. We always carve out a couple $1 million for our own just group of individual investors. And so by having that kind of diverse pool, we feel we have a little bit more flexibility, different deals for different groups. And so we kind of take a little diversified approach to building up the capital stack.
I love it. Spencer, you've had a lot of success at a very young age. Who do you think's had the biggest impact on that? Who's been the mentor that kind of stuck out that really moved the needle for you?
Yeah. I've got a lot of good mentors today, a lot of people that are in the industry, people who are still multiple steps ahead of me, but I've been able to benchmark. But if I had to think of the one person that really has influenced me, it's got to be my father. I saw him build a business as well growing up. Started from absolutely nothing. He taught me how to kind of think larger, not think inside the box, and led me down the path of entrepreneurship as the kind of the preferred option, as opposed to go to school, get a degree, get a job. I was taught that was kind of plan B rather than doing your own thing, going off on your own. So very just fortunate to having that upbringing and kind of starting at a young age with that mindset.
Yeah, I love it. We have so many things in common. My father, same thing,
cool.
Entrepreneur. I got to witness him in the house, be an entrepreneur and make one step, one move, one decision, one after the other, build an amazing business. There's no better way to learn than to see it yourself. Last question, Spencer, is listen, you have a great business. You have a tremendous amount of success. Often when you sit in a CEO or a founder's role, it's hard to find free time to think and just sit and ponder and strategize. What's your favorite way to do that? What's your favorite way to carve out time to really think several steps ahead, to find blind spots? How do you do that in your own business to make sure that, you don't get caught? You don't get, some unknown, some black swan, something like that comes up and kind of disrupts your business. Yeah.
I love the outdoors. I do a lot of fly fishing as well as bow hunting. So it's deer season right now for bow here in Indiana, and so going up and getting into a tree stand and sitting for 3 to 6 hours in absolute silence, just observing kind of nature around me it's been incredible. Opportunity to really sit there, think, decompress. It's, you're really forced to, you can't make any noise. You have to just observe. And so that's been incredibly helpful. Not bow season, I do a lot of fly fishing as well, and it's similar experience. I don't really play golf, but I do a lot of fly fishing. So that's kind of my kind of release to kind of get out there, get in nature, but also just decompress, strategize.
Isn't it funny that when you're doing that, that's like when your best ideas pop in your head, right? Probably get your best
100%.
bow stand versus sitting at your desk with your 4 computers in front of you and looking at all your metrics. It happens out when you're away. So I encourage my audience to get away from the business, to not be just so dialed in, to just hustle, to take time away, to think and strategize, and actually go do something that's like mildly occupying, but not something you have to think too hard about. And that's ultimately where the best ideas kind of float in. I love it.
Yeah, absolutely.
Spencer, tell us where our group can find you. I'm sure our investors will, and our audience will want to get a hold of you. Capital LLC, I know, has a fantastic newsletter. Tell us a little bit more about where people can reach out.
Yeah, GreatCapitalLLC.com is the website. I mean, you're welcome to sign up for our newsletter. When you go there, there's a button to do that. We're also on all social media platforms. If you just Google Great Capital, we'll pop up. And we'd love people to join the newsletter. We think it's one of the better multifamily newsletters really in the industry. Comes out every week, every Thursday. And we have a whole team that's basically aggregating every new research report or data set that comes out from, whether it's the brokers, the property management, the real pages, the Yardi matrices, really anything that's kind of like a hard research in multifamily, real estate, and the economy. We're aggregating that, sending it out every week. It's no fluff. It's just like, here's what's going on in the market. Let's keep you updated from a macro sense, but also micro. And we have great reception. People seem to really enjoy it. And so, go sign up, GreatCapitalLLC.com.
Fantastic stuff. Listen, Spencer, thanks so much for popping on today. Appreciate you carving out some time.
Hey, thank you, Josh. Really appreciate it. This was great.
Well, hey, I really, really had a great time interviewing Spencer right there. Thank you so much for listening. Listen, don't forget to subscribe to Accelerated Real Estate Investor. Open up your phone, open up your laptop, your browser, and click the subscribe button now so you never miss another episode. Also, don't forget to leave us a rating and a review. If we did a great job, tell us. If you hated the interview, tell us. Either way, I'd be so grateful to hear your feedback. And also, don't forget to join our free Facebook group. It's called Accelerated Real Estate Investor. You can find it in Facebook. You can join for free and get fantastic free content. Finally, don't forget to visit freelandventures.com/passive, especially if you're a passive investor seeking your next investment opportunity. Just like Spencer and I talked about today, your money cannot sit in cash in today's environment. If you're sitting in cash, you're getting destroyed by inflation at roughly 5% right now per year. The dollar is being devalued. And so you have to get that money invested in order to keep up and surpass inflation to protect your family. So don't forget to visit freelandventures.com/passive. Thank you so much for being here today, and we'll see you next time. Take care.
You were just listening to the Accelerated Investor Podcast with Josh Cantwell. If you enjoyed this episode and learned something new, help us build the AI community by leaving a review and 5-star rating on our iTunes podcast channel. Also, don't forget to subscribe so you never miss another episode. To see passive investing opportunities, visit freelandventures.com/passive. To start your journey toward the lifestyle you've always dreamed of with multifamily apartments, apply for one-on-one coaching with Josh at www.joshcantwellcoaching.com.